Hey, it's Cava&Faulkner with Cava&Faulkner, Elk Grove, Living Trust Attorney, Sacramento Estate Lawyer. And thank you for tuning in to another edition of Catching Up with Christine. We missed the days, we got our days wrong, so we're posting this on Friday instead of Thursday. And today, stay tuned because we're going to talk about the Biden tax cuts proposals and how that can impact you. We're going to talk about what happens if the estate tax exemption gets rolled back. And also, what about those the step up in basis that could be eliminated. So stay tuned to the end of the video to learn, well, just how that could impact you and give you some food for thought to decide what actions you might need to take to protect yourself and to educate yourself and protect the people that you love. So let's get started. Here we are in 2021, and for those of you who don't know, the estate tax exemption is $11.7 million per person, or almost $24 million for a married couple. So what does that mean? That means that you can pass on individually $11.7 million in assets to another person before any type of estate tax or death tax kicks in. It is also called a transfer tax. Gift taxes are transfer taxes, estate taxes are transfer taxes, and they are generally the highest tax that you will pay. So under the Trump administration, we had very generous estate tax exemption that is bumped up every year for cost of living. And the way the law is written right now, that law is scheduled to sunset. And so if nothing happens over the next 4 years, 4 years, 5 years, at the end of 2025, or basically beginning in 2026, the estate tax exemption will drop down to $5 million per person. So basically $10 million per couple. So you might be thinking to yourself, well, you know, how does that really impact me? I'm not affluent. I'm not super wealthy. I'm never going to have, $11 million in assets. I'm never going to have $23 million in assets. And that may be true. But it doesn't take that much to bump your assets up when you account for all of the types of assets that people traditionally own that are included in their estate for estate tax purposes. And so those assets include your real estate, your bank accounts, investment accounts, all of your kind of liquid assets, stocks, bonds, businesses that you may own. Those are all includable in your estate, your retirement accounts, and life insurance. And so many times people don't realize that even though they may never see the benefit of a life insurance policy, as in like the death benefit, that is actually includable in your estate. So you can see how pretty easily it's easy to rack up lots and lots of assets in that estate tax column. So what does that mean? So right now, yes, generally affluent people are only looking at having to pay an estate tax, but under the Biden proposals, and nobody is really sure what exactly that means, whether there will be a rollback to $5 million per person or perhaps $3.5 million per person. So you can see that that is a considerable rollback, almost 2/3 of what we have now, which means that if it is rolled back to 5 million, it is 5 million per person, 10 million, per married couple. And then of course, 3.5 million per person or 7 million per married couple. It's a lot easier to get to the 3.5 million, obviously, than 11.7. But if you do have an estate tax situation, then you're looking at a very high tax rate. Right now, the tax rate is almost 40%. That will be the highest tax that really anybody will pay. And obviously, every dollar you're over the estate tax exemption, you will pay to the federal government about 40 cents on the dollar. So it is a huge hit. In California, right now, there is no estate tax. So it is just a federal tax issue that we're dealing with. One of the other questions as well is if There is a rollback to the estate tax exemption. Will it be made retroactive, and how can that impact your planning? No one knows. It's never clear until the law is enacted. But whenever the estate tax is rolled back and it is made retroactive, it means that if you already have planning in place, you may need to do some additional planning to make sure that you are protected. So we are generally looking at what is the law in the year that a person passes away. That is usually the relevant question. And so retroactivity always throws a wrench in the works. So there is a quick tutorial on the estate tax exemption. I will mention just briefly, I'll make another video on this, that the estate tax and the gift tax, lifetime gift tax exemption are all rolled into one. A little bit too complicated to break that down in the video today, but I will do another video addressing the unified credit and what does all of that mean. In addition to the yearly gifting exemption. So how do those two things differ? We'll talk about that in a different video. So let's talk about the step up in basis. So the step up in basis is relevant to capital gains. And so let's say that you own a home that you paid $100,000 for when you purchase it. So that is your tax basis in the property. So we only care about the tax basis for capital gains when you sell a property or when you pass away. And so if you've ever owned a piece of real estate and you sold it for more than you bought it for, the difference between what you bought it for and what you sold it for is the potential capital gains. And of course, there's always the risk that you'll have to pay a capital gains tax on that. So what is the step up in basis and how does that work? So traditionally, between husbands and wives and parents and kids, there has been a step up in basis. So what does that mean? Let's say a married couple purchases a home for $100,000 and the home is worth $500,000 at the time one of the spouses passes away. Well, the surviving spouse will take the new fair market value as their tax basis, and there will be no capital gains tax. Now, the surviving spouse passes away, and now the house is worth $1 million, and that is now going to be inherited by the kids. So there has traditionally been a step up in basis to the fair market value at the time of the second death. So you can see that between the original purchase price of $100,000 and the value at the time of the second death, $1 million, there's been $900,000 in gain. Wouldn't it be great to be able to wipe all of that gain out and not have to pay any capital gains tax on it? The kids just inherit a $1 million house and they don't have a tax bill for capital gains that comes along with it. Well, that is what the law is currently, but the Biden administration is considering wiping that out. And so what does that mean? That means that there could be a tax every time children especially inherit that $1 million property. So they could end up having to pay tax on $900,000 or possibly just $500,000 between what it was when the first spouse dies and what the value is when the children inherit it. So wouldn't it be better if you didn't have to pay a 25 or 30 or 40% tax, depending on what the Biden administration does with the tax rate on $500,000 if you are the child inheriting that property? If you are going to receive a piece of real estate, wouldn't it be great not to have to pay any taxes? Well, there is the potential that that is going to be revised, either eliminated entirely, so taxes will have to be paid by those inheriting a piece of property. And it's not just real estate, it's also stocks, any kind of assets that can appreciate, investment accounts. So it remains to be seen what the Biden administration does in terms of amending the tax code, but these are some things that are on the radar as possibilities for changes in the future. And be thinking about how this could impact you if you already have planning. We'll be, of course, alerting our clients, and I'll be doing more videos on exactly what is happening with the Biden tax changes. If you already have a plan, it could mean, especially if there is a revision significantly downward in the estate tax exemption, that you need to do more advanced planning to make sure that your family never is exposed to an estate tax. But we're not there yet, which is the good news, and I will continue keeping you updated. Thank you so much for tuning in to Catching Up with Christine. If you like our content, subscribe to our channel, like our videos, and let us know what else you'd like to hear about. Take care and have a great day. Bye-bye.